Good afternoon and welcome to the AQUIS Exchange PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Alistair Haynes, CEO. Good afternoon to you, sir.
Good afternoon. Thank you very much indeed, and welcome everybody to the AQUIS Exchange PLC results for the year 2023. I'm Alistair Haynes, the founder and chief executive of the company, and I'm joined here by Richard Fisher, the chief financial officer.
All right, good afternoon, everybody.
Well, just as a reminder to anybody who is unaware of AQUIS, AQUIS is a technology-driven challenger exchange group and creating better markets for the modern economy. And I'm delighted to say that we are delivering against that vision. And again, just a little bit more detail. What do? We operate the secondary trading in our AQUIS Markets division, and that is for 6,500 stocks across Europe. We operate a primary market, the AQUIS Stock Exchange. We use our own proprietary technology, which we license to other people, and we sell the data from the exchange, the primary business and the secondary business. So let's look at the highlights here. This has been an incredibly difficult year for people in financial services. And therefore, I'm incredibly proud that we are still delivering a strong performance with that background. We've grown net revenue by 13% to 22.7 million, and we have grown our profits by 15% to 5.2 million. Let's just go straight into the numbers, Richard.
Right, thank you, Alistair. Yes, so as Alistair says, we're very pleased with the financial performance in 2023, and that's driven from the start with a very strong growth in our gross revenue numbers from 20 million to 23.7 million in 2023. We step down through the income statement, you'll see the provision movement. We took a provision charge of 1 million, and that's just against the revenue recognition on 2 new contracts and 2 extended contracts in the year. And that steps us down to a net revenue of 22.7, which, as Alistair said, is 13% up year on year. We then step down to look at operating expenses. We're up by 2.1 million to 16.4 million. And there's just a couple of drivers that I'd pick out for what's moved the operating expenses like this. The first is really around our investments that we're making, and those are twofold. They're first of all into people. So headcount has increased by 4 year on year, and that's largely driven by our sort of technology development team and our technology sales force. We've also made investments into our technology, and this is very important for us as we continue to develop. We continue to spend to grow our expertise and to deliver against our forecasts. The last point in our operating expenses is around is around staff cost inflation, and where we've had an overall increase of 9%, and that includes the impact of promotions and any other one-off increases in the year. If we step down through that operating expenses, that takes us to an EBITDA of 6.3 million in the year. If I then look to the depreciation, amortization and interest, you'll see that's improved by 0.2 million in the year. And that's due to an increase in our interest income. As interest rates have risen, we've been able to earn a higher return on our cash balances. But the underlying depreciation and amortization remains consistent year on year. And that's quite an important point because we are continuing to invest both from a CapEx and a capitalization of intangible process at the same rate that we are amortizing those balances. So we continue to replenish and renew our technological infrastructure. You then step down to profit before tax, which is at 5.2 million, a 14.8% increase on the prior year. And that then finally gives you an earnings per share of 19p, and that's against the 17p basic EPS last year. So I said overall, a very pleasing set of financial results for the year. We then turn to the next page, and it's actually just picking out a couple of highlights that I'd like to talk through. And it's first of all looking at the split of net revenue by division. So if we take technologies first, we see we're up 22% year on year to 6.3 million. And that's driven by the 2 new contracts where we recognized revenue and also 2 contracts that extended in the period. If we then turn to markets, the net revenue is up 7% to 10.9 million. And that's despite the difficult market conditions we've seen, where market volumes were lower in the second half of the year, especially. So against that backdrop, a very strong outcome. We then turn to data. That's up 24% from 3 million to 3.7 million. And that's largely driven by the impact of price increases that we announced last year. And the last segment we talked to is AQSE. And revenues there are up 8% to 1.8 million. And again, that's against an incredibly difficult market environment where the ability for IPOs was very much constrained. But against that backdrop, we still grew revenues by 8%. You then look on the right-hand side of the page, you'll see the cash balance at year end of 14.8 million. And that's up 0.6 million on last year. But it's actually what else have we achieved in the year with our cash, not just the endpoint that interests me most. If you look through, apart from the OPEX spend we made, there have been 3 principal uses of our cash. The first was we made a $0.75 million investment into Optimix. And as Alistair will talk later, that enables a future use of block trading. Secondly, we transferred 1 million of cash into our employee-based trust. And that's as we sort of provide for future requirement against share option schemes. And also, as I alluded to earlier when I spoke about depreciation, we've made CapEx spend of 0.75 million in the year. So it's against the backdrop of those incremental uses of cash, we still have generated excess cash and grown our cash balances to 14.8 million. And that really does provide an interesting opportunity set for us in the future. If we turn to the next slide, for those of you I've spoken with before, it's perhaps my favorite slide. And it's not just the stark statistic of 18.3 million increase in revenue since 2018, but it's actually the chart on the left-hand side that really does show the growing benefit of diversification of our revenue streams. And as if you look particularly from 2021 onwards, you can see the increase in technologies revenues and also data revenues as increasingly important aspects of our portfolio of revenues. And that's shown in the pie charts on the right-hand side. And if you look, this is setting out the markets business, so the proportion of revenue we derive there. So now down for the very first time below 50%. And it's this diversification of revenues that's enabled us to deliver such a strong outcome against what is a very challenging market backdrop. So on that point, I'll now hand back to Alistair and we'll start to begin the divisional highlights.
Thank you very much indeed, Richard. Let's have a look first of all at the AQUIS markets. AQUIS markets today is a major part of market structure. In fact, if you look for UK and Europe, 1 in 20 transactions in terms of value are executed on the AQUIS exchange. I'm delighted with the strategic strategic initiatives that we took for 2023 and managed to complete them. We now have a diversified suite of products. We have a periodic auction. We have the closing auction. We have a dark pool. We have the conditional order types. We've invested in Optimix to make quite certain that we have the capability of block trading. And of course, we have the lit book. Now, what is important is what happened in November last year, where we decided to make a change to the rule. With the rule, if you remember, said that anybody who was a non-client proprietary trading firm, basically that is a prop trading firm, examples of that like high frequency traders or whatever, we had a rule which says they could not cross the spread in our market. That meant that if there was an offer, they couldn't take the offer, they couldn't hit the bid. All they could do was supply liquidity. And whilst that differentiated us to other exchanges around Europe, it also meant that the time to execution on our exchange tended to be slower than our competitors. And whilst we actually had a different type of liquidity there, and we actually talked about the lower toxicity and the way that prices didn't move on our market like others, it did mean that people had to take longer in terms of milliseconds to trade on our market. Now, having spoken to all the banks, we found that the bank liquidity, the passive liquidity, was not coming to AQUIS. So in November last year, we decided to change the rule, but we did something that was unique. We actually changed the way that our data feed, in order to allow liquidity providers on the market to have a choice as to whether they would accept orders or not accept orders from proprietary traders. This was the first time, I believe, anywhere in the world that any exchange has been able to do that. And it meant that everybody was actually allowed into the market. If you look at this slide here, we can see the impact that that had. Our total market share in November last year was just under 4.5%. And within a matter of a few months, we've now got that to just around 5.5%. If you look at the bottom left-hand chart, you can see that the lit trading, that is just only the lit trading done on the market, has actually significantly improved. And interestingly enough, as we've grown our market share increased both on the market at close product and also the dark pool, the AMP, the AQUIS matching pool. If you look now and say, what was the effect here? What have we actually done? Well, prior to the rule change, 18% of our liquidity was supplied by banks, meaning 82% we were reliant on liquidity providers. Today, that number is 41% by the banks and only 59% by the liquidity providers, a much, much healthier outlook. And we believe that that actual bank volume or percentage will further increase. So what that shows us is that the banks now realize that the time to execution has actually dramatically changed, and they will continue to place orders. Good news here is today, only a few of the banks have made that change. There are further progress to be made. Now, I've mentioned Optimix before, but I also must mention how hard these markets with lower volumes are. In those kind of conditions, we've seen takeovers of various members. And I'm delighted to say that by the end of the year, we still had 42 members in these difficult conditions utilizing AQUIS every single day. So the big question is, I promised everybody when I founded the business that we could get AQUIS to become a top 3 player within Europe. And in order to achieve that, we have to reach around about 10% market share, 10 to 11% market share. And I hope this chart outlines how we are going to achieve that in the medium to long term. Well, the first thing, and a really crucial thing, is the impact on lit. Today, out of the total market, our lit trading accounts for about 2.62%. And as I said before, we've seen a pretty dramatic change since November, and I believe that we will continue to see that change. And over the next few years, I believe it is perfectly possible, and I believe we will achieve something north of 5% of the total trading through our lit book. If I look at the dark book, when we took on the assets of UBS MTF a year and a bit ago, it was about 0.3%. But UBS, prior to Brexit, used to have 2% market share. That platform operates on a much more advanced technology, and we've already grown it from 0.3% to 0.9%. And again, I remain full of confidence that over the next few years, we can achieve at least 2% through our dark pool. The periodic auctions, I believe we still need to make further changes. And during 2023, we made some technology changes to the periodic auction. And I do believe we can double that market share to more than 1%. And of course, the closing auction, we've seen significant progress over the last few months. And we're already at 1.5% of the closing of the total market share just in the close. We need to make that to 2%. All of those targets are achievable. All I believe will happen in the medium to long term. And if we look at what medium to long term, 3-5 years, something like that. If we do that, we can become a top 3 player. Now, why is that important? That is important because of the consolidated tape. And we'll talk a little bit about the consolidated tape, the impact that has on our revenues in a few minutes. I'd like to now turn to AQUIS Technologies. This, I believe, is an absolute game changer to our business. It is inevitable that in the future, exchange technology will move to the cloud. Exchanges today want a system that is truly designed for the future. We are the only provider in the world that can allow somebody to move from a data center driven platform to a hybrid solution where they can maintain their data center whilst they pay for it, and ultimately into the cloud. You want to be in the cloud because the economic benefits are huge, as long as you have the high class technology software to be able to operate your platform. Let's have a little look at the history of AQUIS Technologies. When we started this business 11 years ago, some of us had come out of the largest trading platform in Europe, and we recognized and realized we had to build a very, very advanced technology. We took a group of people together who created the fastest matching engine at the time in the world. It wasn't until a few years ago, and some of you will remember this, that we did this project with Amazon Web Services and the Singapore Exchange to build the first exchange-grade technology in the cloud. Resulting from that project, we developed a system called Equinox, the world's first 24/7 matching engine. And that really has been the game changer for us. We have signed 9 contracts and we have recognized the revenue of 7 of them. What does an exchange want? As I said, they want to be able to transfer to the modern technology. And that is exactly why we won contracts like the Colombian National Bank, the Banco de República, to operate their bond market. We beat the world's top providers in technology 3 times over the last 18 months. What this is telling us is that we have something that others cannot provide. And that is why we have 2 new contracts signed last year. One was a central bank. One contract moved from a design and consultancy with us. One contract was renewal. One was extended. But let's actually have a look at the true opportunity that AQUIS Technologies will give our investors. We know for the fact that having won these contracts over the last few years, that we are one of the top 5 global players here. But what I don't think we've explained well in the past is this opportunity and what is the total addressable market. People often think that something like the United States, there's only 2 exchanges, NASDAQ or NYSE, and London might be just London Exchange, or in Europe it's Euronext or whatever. There are 350, more than 350 exchanges in the world that need this type of software. And we believe that we can capture a significant market share. Because we've beaten the competition, and because we can, we think we have not only the solution to modernize, but actually the software in order to do it. We think that within the near term, or the medium term, we can capture something like 5 to 10% of this. And ultimately in the long term, maybe 20% or even more. So what does this do from a cash perspective? Again, in the past, this has been clouded by the various accounting standards that we have to comply by. And we've listened to what shareholders have said to us and said, what does it really mean in cash terms? Now, this is not guidance, but this is a conservative view of what we believe how cash operates in selling these contracts. The red segment is literally from 2017 when we did our first ever technology contract. And then we look 5 years forward to 2029. And if we didn't do anything else, and just had the contracts we have today, we have £21.2 million, which is the value of those contracts, of which 13.1 million is still due to come in. And you can see from that chart in 2023, we actually received £2.1 million in cash from these contracts. We do nothing, and you can see how the chart and the red line or the red segment goes down. But I can tell you that having done a number of contracts, and particularly something like the Colombian National Bank, is that the RFP process took there about 18 months, and we will be delivering that bond market to them in 2026. These are long term, and there is absolutely no way that having delivered that people are going to go through the same RFP process every 5 years. So these contracts, and when you look at most exchanges, they hold their technology for 10, 15, 20, sometimes even 25 years. So we don't believe that there's any real likelihood of contracts not being extended. If the current contracts are actually extended, that is the grey segment of that chart. That is an additional 8.6 million cash coming in. Now let's have a look at it. You looked at the total addressable market. Say we were 10% of that, that's another 35. 5%, 17 contracts. For the next 5 years, let's look really conservatively and say we only do 2. If we do 2 at the basic price and the basic length of contract, and there is certainly pricing capacity here to increase. But let's be conservative again. If we did that to 2029, we would have £14.6 million additional cash. In total, that would mean £44 million of cash. If you think about it, and we achieve what we think is not a ridiculous target, and you capture 20% of your total addressable market, you are talking about very, very significant numbers and really game-changing bottom line P&L for this company. It is for that reason, the unique nature we have of the technology, the position, that the fact that we are ahead of everybody else in the world today in being able to provide this, that we will continue to invest heavily in this area. We think this is a real watershed moment for the company. On that point, I now want to pass over to data.
All right, thank you, Alistair. Yes, so at 3.7 million, data revenues now make up 16% of our net revenues. So the net revenues are up 0.7 million year on year, and that's as we saw the benefit of the price increases that we announced in September 2022, which took impact from 1st of January 2023. So we've seen that impact flow through to the current year's P&L. But as we look forward into 2024, I'd also note that we announced further price increases in September 2023, which will take impact from the 1st of January 2024. I would also note that we have started with the effect in June of charging our members for data, and we conservatively believe that would deliver a further 0.7 million of revenues on an annual basis. So those are just by themselves going to continue to help to drive the significant growth we've seen in the data revenues. But perhaps more exciting still is the future opportunity set provided by the consolidated tape. And we remain with our view, as we've said for the last 6 and 12 months, is that this is a case of when and not if that a consolidated tape is brought in. Over the last 6 months, since we provided our half-year results, we've seen the regulatory progression that we'd hoped to see and remain confident in our timelines of a 2026 recognition of revenue. It may be towards the end of that year, but we believe 2026 is when revenue would be attributed. So I think from our perspective, and a number of people have asked, have we a value that we could ascribe to what that consolidated tape could bring? The rule set for how the revenue on a consolidated tape would be allocated is not known fully at this stage. But with what we are aware and looking at how, for example, the consolidated tape revenue in the US was attributed, we believe that it could deliver at the current market share, so say a 5% level, it could deliver about the same as we are currently earning. So it would double the 3.7 million that we earned in 2023. If you then, as Alistair was talking earlier, are able to drive your market shares up to, say, 10%, there is a natural corollary between the two, and we would see that revenue benefit from the consolidated tape also double. So the opportunity for us as a consolidated tape comes towards us is significant. And that is why we continue to seek to drive further change in that market share. If I then turn to the next slide, we're looking at the AQUIS Stock Exchange, and that's delivered another good year with net revenues up to 1.8 million, despite the very challenging market backdrop. And I think for us, the most pleasing aspect of this performance is that in such a challenging market, AQSE is increasingly seen as the natural home for growth companies. So in 2023, we saw 16 IPOs, and that's now for the second year running more than any other growth market in the UK. And I think also, if you turn to the next slide, I think this really shows how AQSE is being increasingly accepted as that natural home. The pie charts show the progression of IPOs, how are they coming to AQSE, and year on year on year on year since acquisition, we've seen that number grow. And another proof point that we're incredibly proud of is in the current year, we have seen 3 companies graduate from our access segment to our Apex segment. So as they have reached the size and regulatory requirements, they've enabled that change. And that for us really has started to demonstrate that those 2 markets are working. But I would also say that in the near term, we don't see this as delivering material revenue progression. But what it allows for us is a very significant credibility and market presence that it provides across the group. We spoke here about the winning the Bank of Colombia contract that's so important for our stepping stones for as we grow our technology licenses. That was partially achieved by the credibility given from running a recognized investment exchange. So a very powerful part of our armory. But I would also say that we still believe that AQSE in the long term will be a significant revenue driver. So at the moment we have 105 issuers. As markets return to more normal conditions, we would look to see that number grow over time to multiples of that. And once we achieve that state, the revenue opportunities associated with data, maybe the creation of an AQUIS Stock Exchange indices or UK growth fund indices, the opportunity is really quite exciting. So I think for us, AQSE is delivering here and now a credibility to the AQUIS group, but also remains a very exciting future opportunity. So on that, I'll now hand it back to Alistair for some concluding remarks.
I'm incredibly excited about what's happening at AQUIS right now. I accept the fact that there are significant headwinds out there, but at some point in time, these will turn into tailwinds. We have a proven track record. Ever since we IPO'd, we have grown revenues by over 400%. We've diversified this company so that not only do we have a full product suite within the markets business, but we actually have significant other businesses. There are 2 areas right now that I think are absolute game changers. The first is this technology opportunity, which we must take advantage of, and we're already, have things like, shortlists for other national exchanges, other central banks who are talking to us. So there is a clear opportunity that we need to take advantage. And the second is this drive for market share, which will be paid off not just in the revenue gain from the market share itself, but actually from the consolidated tape. These are significant changes to the bottom line of the company over the next few years. There's a very, very exciting opportunity set. You have a management team that is experienced and has been for a good length of time in this business, but we continue to increase bench strength and we will continue to invest. This company is not frightened of innovation. This company is not frightened of investing. I'm really, really looking forward to the day when instead of having the headwinds of Brexit COVID, war in Europe, geopolitical issues, that when things eventually calm down and we have a tailwind behind us, I'm looking forward to be able to report to the shareholders the incredible news I think we can give. Our outlook for 2024, though, is very much in line with board expectations. So on that note, I would be very open to answering any questions that you have.
Perfect. Alistair, Richard, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. We have already had a few questions come through today, so I'll start with the first one here, which reads as follows. How did the economic and regulatory environment affect AQUIS's operations and strategic planning?
Sorry, how do the economic and regulatory environment affect? Well, look, I mean, you know, the regulatory environment is very, very important to us. I mean, for example, let's just take the cloud technology. We are the first in the world that operates a recognized investment exchange already in the cloud. So there were lots of people worried about security and you know, could you operate a serious market in there? Well, we proved that, and I think the regulator here was very proud about the fact that the UK was the first to do that. Economic is really important to hear, because the problem that this country has received is we have phenomenal entrepreneurs. There are actually 900,000 businesses created in the UK last year. That is more than ever happened in this country. Where we're so bad is that not startup, it's scale up. And we need to make quite certain that as an exchange group, we can actually get scale up capital. We neither get the public into public markets because there are not the incentives there to do that, or do we get the international funding that we need around the world. The latter is because of the political shenanigans that we've seen happen over the last few years that has actually put the UK into a sort of almost like a penalty spot. They want to see more sustainability, you know, penalty box. It's just, you know, they want that sustainability, the proof that we've got confidence back in the markets. And as far as the public are concerned, we absolutely have to drive for things like tax incentives. One of the great examples there is stamp duty tax. The industry or the government sees stamp duty tax as a fat cat tax, and therefore they don't really want to cut it because it will be seen to benefit the wealthier people. It isn't, because the very people who pay stamp duty are actually the retail market themselves. It is a tax that actually detracts from markets. So economic and regulatory issues do have an effect on AQUIS. We've managed over the last few years to be very innovative and be able to create the growth that you can see as investors today that we've achieved. However, when that regulatory environment is made easier, when, as I believe, we will see the regulator actually accepting the fact that risk should have reward against it, and we shouldn't take risk completely out of the market, I think you'll find that we're in a very, very strong position.
Perfect. Thank you very much, Alistair. Just turning to the next question, which starts with a comment saying, great results. How do you see the revenue mix changing next year and then over time?
Yeah, that's a very good question, David. Thank you. Yes, because I see this as changing in probably a couple of stages, and it's probably ties through to the two significant opportunities that we've spoken about here with regard to tech sales and also the consolidated tape. And if you look at the timing of how we see those, we've seen technology sales really grow in 2023. And I think if we're able to deliver the level of growth in contract wins that we're expecting, you would all else equal expect to see technology revenues be growing proportionally. And then in 2026, you'll see the first part of consolidated tape revenue. It obviously wouldn't be a full year's impact, so more of a 2027 impact. But at that stage, you'll see data as a proportion of our revenue significantly increase. So I think you're going to see a slight flux through that period. So first of all, taking account of the technology contracts, but then secondly, the growth in data revenues. I hope that helps answers the question. But yes, it's definitely one that we're looking at, and it's very interesting how that mix of revenue is changing over time.
Perfect. Thank you very much, Richard. The next question here. What's your view on the number of companies delisting from the London Stock Exchange, both full list and AIM? Do you see this as an opportunity, and how are you looking to exploit it?
I don't think the delisting of any company from any exchange is a good sign at all. And I don't want to exploit that, because the very fact that somebody's delisting tends to mean that they don't enjoy the public market and they're not getting the benefits of the public market. Our opportunity here, and I said this on a panel yesterday, is we're not focusing on trying to win the next unicorn to come to AQUIS. Funnily enough, the unicorn, having grown to the level that it is, doesn't change the UK economy. What I'm interested in is scale up capital. And you can see that, for example, when I said the 900,000 companies, if 1% of those actually go from being a sort of 1, 2, 3 person company into actually a more mature business and then needs to scale up, then there's a very, very significant number that want capital. The public market should be seen as that, by having access for retail investors to be able to invest, which they can't today because of the admissions document, although that is now changing, and for institutions to be involved and be able to, pension funds, etc., etc. So we want to try and get those companies into a much earlier stage into the public markets, and that means making their life simple. It doesn't mean all the complexities that they might have today. There is a phenomenal opportunity to fund through the public markets the heart of the British economy, because if those companies succeed, the government gets more PAYE returns, it gets more corporation tax. And I have argued consistently that those types of companies on secondary or primary raisings on a regulated growth market should be exempt from capital gains tax or part of an EIS scheme. The numbers add up. But I think, unfortunately, this is becoming an old government, and I think the modernization and the way going forward is not going to happen anytime soon. But post-election, with a government that really wants to change things, then I think actually we've got great chances of, over the next few years, it's not months, abolishing stamp duty, getting more access for these companies and for getting capital on the public markets. So I think the opportunity is not taking companies away from the London Stock Exchange that delist. I'm happy to take companies away from the London Stock Exchange that actually want to be public. That is a very different thing. But if you're delisting, I think it means that you've got fed up with being public, and that is not something that necessarily they're going to get the experience here. So hopefully that answers that question.
Perfect. Thank you very much for that. Next question here. How have AQUIS's divisions synergized to drive growth? Are there examples where technology or data from one division has propelled advancements or revenue in another?
Well, I'll start that at the beginning and then maybe pass over to Richard. But yes, a lot of people say that AQUIS is a complex company, and maybe that's our fault in the past. But what do? Primary trading and secondary, we have a technology and we have data. They are heavily linked together. So I think the example that Richard gave there, which was, would we have won Columbia if we hadn't had the higher status that we have by having the recognized investment exchange license? Probably not. What it does is, not only is it a profitable business, be it a long-term growth business for us, it has also propelled us round the table at the highest level. We're already being shortlisted for some national exchanges for our technology. We wouldn't get that. Data, absolutely. The example there is the synergy between driving market share and the revenue generation we're going to get out of data because of the consolidated tape. And the technology business, the great thing about the technology when you buy it off AQUIS is any upgrade you get from running the 7th largest exchange in Europe, so we're doing significant volume of 2 billion plus a day, any advantage you get that AQUIS has to be at the cutting edge and we upgrade that is given immediately to our clients. So if you're a technology client, unlike our competitors, you get all the advancements as we progress. We do that because although we might be able to make more revenue by charging, we have one single version. We don't have version complexities when distributing our technology. That means that we can be very, very efficient and have significant cost savings. I don't know, Richard, if you want to.
Yeah, it's probably just one extra I'd add, and it's perhaps almost too obvious to say, but the fact, if you think when we're selling our technology to a client, one of the proof points we have is that technology is running on our own MTF, and it's running at a volume set that most of these clients would never be reaching. So they are in essence buying a proven cutting edge technology. So any other provider who says, I have a great technology, but doesn't have that evidence point, is just not a game. We are literally able to say we've got the best technology available, and we are day in, day out demonstrating that. So I think that's a really powerful synergistic benefit that you see across the group.
Perfect. Just turning to the next question. Can you please provide more detail on what drove the ECL provision in 2023?
Your favourite topic.
My favourite topic. So it's a very good question, Brian. And this is an accounting-led answer, so apologies if somewhat dry. But the way we look at revenue, we are forced to recognise revenue on contracts, some of it up front. And what we do is we make a conservative estimate to provide against some of that. So actually, the fact we've taken a provision this year is curiously a positive. And it's driven by the fact that we took revenue on the 2 new contracts and also the 2 contracts that we extended. So we have made a provision against that. And all else equal, if there is no credit event in the future, that provision would actually unwind over time. And to date, we've never had a credit event. So we are providing on the basis of something we have yet to see previously. And yes, that's why we talk to net revenue, because we believe that ECL provision will unwind over time and you'll see that benefit. So I think it's a conservative way of presenting our results that the accounting standards demand. But it's not that we believe there to have been any downgrade in the credit of any of our clients. It is purely a requirement for what we have recognised in year. So apologies, it's a classic interplay of IFRS 15 and IFRS 9 if you really want to get into the details.
Perfect. Thank you very much, Richard. Turning to another question here from Brian. What prevents AQUIS launching in North America?
Well, good question, Brian. I mean, the answer is nothing. We could go to North America. I think what we do more likely to happen is that our expertise and knowledge about markets is European. We understand a reasonable amount North America, but it's more likely to be done through a joint venture, partnership, acquisition, or whatever, if we looked at it that way. I think, for us to go on our own without any, that's a big challenge. And I don't want to push up costs significantly within the business. I think there are plenty of other better ways to use the cash, which I can see a question that's just come in from Alberto about what are we going to do with the cash that sits on the balance sheet. I'm going to pass that over because I know Richard answered that earlier on today and very eloquently.
And I think it's a very, very good question because we're sitting on 14.8 million of cash now. We are strongly cash generative. And as we set out in the technology contract slide, as we win more contracts, that level of cash accretion will, if anything, increase and over time increase at a proportionally higher rate. So yes, we are sitting on excess cash now and we will have more cash to come. And I think the way we are regarding this is that this really provides an opportunity set for us at the moment. There's both internal investment. There's a number of opportunities we're looking at that could we internally invest to really increase the speed of our strategic delivery. Also, there is the potential for what could that cash be used externally. Are there any opportunities as assets are priced low at the moment that we could acquire something to help accelerate our strategic path even further? So I think it really does give us an opportunity set. So yes, it's perhaps a problem over time, but it's a problem I'm rather enjoying having. It definitely gives us some rather interesting opportunities.
Yeah,
I don't know, Alistair, if you have better views than I, but
No, I mean, it's good that those 2 questions. I mean, if we're going to make investment into the United States and have geographical, wider geographical spread here as a company, which obviously is our ultimate goal, then you will actually need something to finance it. And it is that balancing act between the cash that we're generating and the investments we make. Of course, there are all the things about share buybacks, dividend payments, and things like that. As this cash comes in, and we believe there will be significant cash in the future because of the technology, because of the consolidated tape, then that is something that we need to look at very, very carefully. But as I said, and as Richard said, this is a really nice problem to have, and it will certainly benefit shareholders.
Perfect. Thank you very much. I think you actually covered the last two questions there. So, just before redirecting investors for their feedback, which I know is obviously particularly important to yourselves, Alistair, if I could just ask you maybe for a few closing comments, that'd be great.
Okay, well, first of all, thank you all very much indeed for attending today. I would just reiterate some of the things on the conclusion here, which is over the next couple of years with the technology and with the effect of the consolidated tape, this company is really ideally positioned. It is about execution and making quite certain that we execute this well. I believe we can do that. I think we've got the team in place in order to do that. And I am very, very encouraged. We all want market conditions to change. We all know that it's cyclical. But at some point, maybe when we know who's in the White House, maybe when we know who's in number 10, maybe when we know what the elections after Europe are. But certainly it will change. And I think we are in an incredibly strong position for the benefit of our shareholders once this changes. Even before I think there is movement in the right direction for us. So thank you all very, very much indeed.
Thank you.
Perfect. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure be greatly valued by the company. On behalf of the management team of AQUIS Exchange PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.